The views and opinions of this program are those of the host, guests, and callers. There is substantial risk of loss in trading futures and options, which you should carefully consider prior to trading.
For over 95 years, we've set the bar. Power, we restored it. Protection, we reinvented it. Record yields, we redefined it. If there's one thing we know at FS, it's that just because something hasn't been done, doesn't mean it can't be done. We're never satisfied unless we take your farming operation to the next level. Run your equipment at peak efficiency and bust the bins this season. Visit fssystem.com.
Well, no doubt we have plenty to discuss here on today's program as we saw soybeans make their way above $13 in the November contract at the close on Wednesday. It's been a pretty impressive week in the soy complex overall. Corn largely chopping around. Wheat moved a bit higher Wednesday again in quiet action. Crude oil as well, something to talk about too here on today's program as we're joined for market analysis by Mike Zuzolo with Global Commodity Analytics. And Mike, always great to have a conversation with you, my friend. I hope you're doing well.
Doing great, Jesse. Thanks for having me back, sir.
Well, let's dive in and talk about what you're seeing in this market trade right now. And let's start with crude oil. We don't normally start with crude oil, but I want to start there. We've discussed that being our canary in the coal mine before. And as we watch the ongoing conflict in the Middle East, and I know we talked about this a little bit last week, what's your thoughts with this crude oil market and how it could potentially be a key driver here across the rest of the commodities, Mike? Let's start there and jump into it today.
Yeah, the question you pose is probably the most prescient and important one of probably this decade, I would guess, Jesse, because this market right now doesn't, I don't think, connect the dots yet with the potential that we're dealing with situations like we talked about last week of the early 70s to mid 80s. And in fact, today, when we hear about the issue with the hospital being bombed, and I saw the protests in Beirut at our embassy, it really harkened back to the early mid 1980s and what I remember seeing on the news, in the evening news, and we only had 3 channels back then. But it really does feel a lot like the 80s again, and it really does feel like a powder keg, in my opinion. And I think the trade doesn't realize that this political and geopolitical environment we're in right now, it's clearly worsening. And my mindset would be that this is like the bottom of the mountain as far as what we're going to have to climb and traverse in the world and in the marketplace, in the energy markets especially. And keep in mind, I say this with the idea that today's weekly update from the Department of Energy showed distillate stocks, which would be your diesel fuel and heating oil, at 114 million barrels. Last September, we made a low of 106 million barrels, and that was the lowest on record for the seasonal time period of the fall months. And this is in part why I recommended a couple days ago, in fact, over the weekend, to go ahead and get energy needs locked in for the winter, starting with diesel and then working towards unleaded. I don't think you need as much on natural and propane because you've got ample supplies right now. But the other reason this is not just the low stocks environment, but the fact that we're not putting a risk premium in this crude oil market. And what I would call your attention to is the value level chart here. We're right in the middle of my value levels, 70 on the undervalue, $100.40 a barrel on the overvalue, right in the middle of those two value levels. But I have another value level that would be if Iran would enter directly into the war and we would have that bigger Mideast conflict like we talked about last week. I would say that $120 a barrel is really in play at this stage of the game, given what's developed since we talked last week.
Well, also, where does managed money sit in this whole equation? I'll flip charts for us here on the video feed, Mike. Obviously, the funds, we see them playing quite a big role in these markets. Where does that managed money kind of play into this whole situation?
Yeah, when I did this chart, I found it very surprising because keep in mind, 2021 time period is when the Russians invaded the Ukrainian land, and the energy prices went sharply higher. But then the managed money started selling into that as of middle of late 2021, and it was an excellent precursor to the end of the grain rally, essentially. And now we've bounced around and we've come off a major low of net longs that sub 90,000 in managed money futures and options. And that was just back in July. And that's what we're talking about is that purple line. And now we've gone up and now we've corrected a little bit. But notice that 265,000 net long position, we're trading right back where we were around last year at this time before the summer break. And it suggests to me, when you look at that in comparison to the blue line, which is your actual West Texas intermediate price, your futures price, that green flat line up there is right around 120 bucks a barrel. So that's my Mideast premium overvalue level. And the way I look at this chart is these two assets, when you compare them, would suggest if the funds really get serious about buying again and get net long upwards of 350, 400,000 contracts of futures and options, that 120 again would be on the table. And so I think this chart supports the overvalue undervalue chart, which that chart, the undervalue overvalue chart, was based upon supply demand fundamentals and me going back in history and some of the stuff we talked about last week.
Well, you and I talk a lot, of course, about wheat, and you point a lot to wheat and needing to be the leader in these markets. I'm going to pull up another chart looking at EU wheat values. As you look at how this week has progressed along in comparison with crude being a driver, what's your thoughts with what's going on in the wheat market, and can wheat end up still being our upside leader here to help grains across the board?
I really think it can, Jesse. I think that's what Wednesday helped us see. Again, the difference between Wednesday and Tuesday's trade was the soybeans were rallying sharply, in part because of continued strong demand and issues with the South American crop. Wednesday morning, we saw another purchase of Chinese soybeans, but the beans really didn't want to go higher without the wheat and the corn. And you could see that. You could almost see the markets looking over their shoulder in the soybean complex and in the meal complex, saying to the corn and wheat, are you guys coming or not? And I think what saved the day and gave us a brand new monthly high in soybeans was not just the currency markets and the bond markets taming down, but and that in part helped bring the European wheat market back above a major trend line resistance that you see on this chart. And so we tested that chart resistance. It is now support on a weekly basis, and we're starting to try and get away from it and go higher off of that towards that longer term resistance line drawn off the 2022 highs, which would be upwards of about 6.25 a bushel. That's essentially where I think soft red wheat should be sitting on a global situation. And like we talked about just a minute ago, when we talk about what's happened in the last week, you and I couldn't talk about the WASDE report, and that's where the wheat WASDE report maybe was negative when it came to the domestic number, but it was very supportive on the global numbers because we lost more competition. And then you talk about the soybean world numbers and the trade seeing almost a 3.5% cut in world soybean ending stocks by USDA. I think you've got several fundamental factors along with the drought in northern Brazil really starting to change the dynamic and the way the trade's looking at the markets. And so the last piece of the puzzle, to me, so to speak, in terms of getting to that next line, that 625 area in European wheat, is that bond market. And it continues in the short dated bonds to go up towards 2006, and in the longer dated bonds, the yields continue to go up towards 2007 levels. So it's truly getting to be almost one major factor that's holding back this market, and I kind of like that scenario.
Well, and too, with soybeans as well, I think another supportive factor was that NOPA report we got on Monday. And as you mentioned, new highs of bean meal that we haven't seen in a while. Soybeans getting above 13. So another factor that I think I'll throw in with just the soybeans. But to your point, I find it interesting watching that charts and watching the markets throughout Wednesday. Soybeans did, in fact, kind of turn it. It seemed like they said, are you coming or not when it comes to quarter wheat, Mike?
Yeah, and you bring up a huge point. We don't want a bean oil-led rally. We'll take it, but we don't like it. It's kind of like walking on 2-inch thick ice. But you get a meal-led rally, that's more like a foot thick ice that you can walk on and do some serious ice fishing to follow out the metaphor, the analogy. My mindset is that what we saw is exactly what you're talking about. We've got very low soybean oil stocks. The trade's been trading that, but they haven't really addressed what's going on with the meal market. the big thing that I've talked to clients about today, because I did come in and recommend, before the report, taking off and rolling down bean puts to take money off the table to see what USDA would do, stepped into the long side on the soybeans and some January vertical calls for many of the clients. And what I'm talking to them right now with some profit on the table is we don't know what China is going to do. We don't know if China, their economic data is out. It looked good, but the market hasn't really reacted positively to it yet. That's number one. Number two is, what does China do with us politically if we start to get into more of a negative situation with one another, especially with these advanced chips? Just today we heard that China and Argentina are going to do a currency swapping mechanism, which means they're going to settle their physical transactions in each other's currencies. And so we've seen one more movement on the chessboard where China is moving towards South America to get their beans, get their meats, get their corn and wheat from them more than us. And so we really have to keep that in the forefront of our minds as we go through this time period of recovery and maybe breakout in the grain markets.
We're having a conversation today with Mike Zuzolo from Global Commodity Analytics. Mike, I want to talk a little bit more the bean corn ratio. I'll pull up another chart for us on our video feed. Wondering your thoughts with how that ratio is looking right now. Give us an update. I know we talk about this a little bit as well here every couple of weeks. What are you seeing right now?
Yeah, this is where, what is the upside potential in the soybeans if we can get the feed grains back on board with them and get everything moving in the right direction. And the commodity index funds want to come in and buy here and do this as we go into the end of the year. And I think there is better than a 50-50 chance of that, given the fundamentals we've talked about. And also given that the equities markets has, I think, started to trade more of the idea that the Fed is done raising rates as we get into 2024. We may see one more this year, but after that, they really are going to probably have to stop. And so if they're correct about that, that should stop the bleeding in the bonds, put a high in the bond yields. And that's where it comes back to this ratio. We bottomed out at 2.6 beans premium to the corn. The standard deviation chart that we have here would say we could theoretically get up towards 2.8 before petering out. And that would suggest that the September high, in other words, the range of lead month soybeans in the month of September, was a low of 12.72 and a high of 13.74. So essentially a dollar range. I think we may be able to get close to that top end number in lead month beans, say around 13.50, if this ratio wants to continue to work higher in favor of the soybeans. But I want to make clear, you don't want the beans to go up without the corn and the wheat, because I think that's going to really shorten the life of the rally, and it's going to make me be a hedger once again. And I won't back off what we talked about last week. Even with these new fundamentals, Jesse, I think you get upwards of $850 of gross revenue in the soybeans. You take the money and run in the cash, and you come back in on the futures and options and buy back if you feel like we've still got 50 or so cents of upside potential.
I want to ask you this question as well. I've asked a few people this here in the last few days, and obviously with November beans got above $13 on Wednesday. December corn hasn't got above $5 yet. Do you feel like, and you look at a lot of charts, you do a lot of great analysis, do you feel like some of these levels are all chart related, that are overhead resistance that we have to find a way to get through, or is it psychological, or is it both, Mike?
I really believe, as I do more research, and I do research at least once a week on the algorithmic trading in the financial markets. And when you and I talk about funds versus fundamentals, what that really means is the financialization of commodities. And so you're talking about computer driven, whether it's technicals or Twitter news feeds or USDA supply demand reports. If you dig into some of these reports that we all look at and read as humans, they're making them in the format that computers can read them now too. And they get through them a lot faster than you and I. So I would say to you that it's primarily technically driven, with the news mindset leading the fundamentals. Where the trade, I don't think, can compensate, and these new ways of trading can compensate, is when you have geopolitical issues, because that's outside their parameters, and they don't know how to get out of things I don't think, in a very speedy manner. When in other words, they don't see the whites of their eyes, and using a battle metaphor. And that's what concerns me about the crude oil market, is that if we're at $100, $120 a barrel, then they'll overdo it to the upside and cut off our demand at the knees, and not keep enough risk premium in long enough to allow the supply side, the people I work for, allow them to get the profit that they need after taking that market signal. That's the biggest problem ever since, I think, the financial crisis, is the farmer and the rancher, no matter how big or small he or she is, they can't get good, strong price signals because they don't last long enough. And that's that financialization of commodities.
Great thoughts. Great thoughts for sure.
Thank
All
you.
right, let's change topics here. Let's go to livestock. And I know one more chart we want to look at on the video feed. Looking at Dees corn versus Dees cattle versus Dees hogs. Walk us through what you're seeing with this chart and just some of the thoughts that you have with some of the spread action between cattle and hogs right now.
This is in light of the hogs in the December contract taking over as lead month, coming in almost $21 cheaper than the October expiration. This is in light of the fact that the Dees hogs just yesterday and again this morning made new contract lows and took out their spring and summer lows, with the idea that China now has economic data out that was better than expected, whether you're talking about retail sales up 5.5% in September or industrial output up 4.5% in September. You've got a Dees cattle market that is almost $120 premium to the hogs. That's your cap. The hogs and the equities markets are serving as a cap against the fat cattle market as we go into the cattle on feed report with a marketings range of 14.5%. These ranges on the placements and the marketings for this week's report at the end of the week, for marketings, in other words, Jesse, it goes from 88 to 102.5%. If it's down near 88%, you've got to wonder, why would Dees cattle need to be $120 premium to Dees hogs? And so we're setting up where we're truly at a point, I think, where you got to feed the bull big time, in the actual bull in the pen, and that being the cattle market.
Well, and you mentioned that cattle on feed report, and I think a lot going on with the cattle market right now. We touched on this. It's gotten a little sideways here, and I think more to the broader scope of what we talk about, Mike. There's a lot of concern here about the overall economy, and it's starting, I think, to slowly weigh on cattle. So you got to balance that with what's going on out in feedlot country, of course, and the low supplies.
Yeah, you've got more things going against you as headwinds than you've had all year long. You've got interest rates, you've got feed prices, and you've got the uncertainty about the recession, as you say. And I think people are starting to get it with the consumption side, and that's why these marketings are so important. You also have the situation where these cattle have snuck up to close to the record highs. I mean, the record high was last month's high of 187.58, I think it was, Jesse. We're within a buck of that now. And so if you make new record highs, why wouldn't you hedge into it? And I've done that already with the feeder cattle clients. I've held off on the fat cattle clients because I think the cash market can be 185, 186 this week. I'll just stay current in marketings. But if I start to see a move sharply higher again in the fat cattle, and we make new all-time highs this week or early next week, say that cattle on feed report does feed the bull, I'll hedge into it, because it's just almost like the soybeans, where you're getting profit you don't get except once every maybe 7 or 8 years.
Mike, great thoughts as always. Before we wrap it up today, anything final you would share or reiterate folks as they're doing their best to navigate these markets right now?
Only thing I would say is harvest is moving quickly in some areas, but it's really slowing down in others. It's going to be a lot different basis levels you're going to have to contend with. I would encourage you to sign up for a trial to the research. Globalcomresearch.com is the website. That's Globalcom with 2 M's, research.com. I'm getting ready to put out a new webinar for the fourth quarter and first quarter of 2024, but it's going to be only a client-only webinar. It's one of the benefits of being a client versus a subscriber. So take a look at the website, get a trial, give me a call, and hopefully we can work together, because I think 2024 is going to be, I think, a bit more difficult and a bit more jagged. And think of it in that mountain analogy, that we're just at the bottom of the Alps right now instead of looking across the valley. So that's kind of where I'm at and where we're sitting right now, Jesse.
Globalcom with 2 M's, research.com is where you can find him. Mike Zuzolo, Global Commodity Analytics. Always a pleasure, my friend. Thanks for joining us on Market Talk today, and we'll talk to you again next week.
Appreciate the great question, Jesse. Have a good week, sir.
You bet. You bet. Mike Zuzolo with Global Commodity Analytics joining us here today on Market Talk. It's going to do it for the show. Find us online, markettalkag.com. I'm Jesse Allen. Have a great afternoon.